probably heard that as an investor, you can expect 10% return on average per year if you invest into the S&P 500. Or maybe you've heard that the FTSE 100 will return you 8% on average per year. Or perhaps that holding a government bond will give you 2%, and this is a surefire, safe, non-risky way of guaranteeing a return. Of course, this is dependent on the bond's duration, but it's not this straightforward. And I'm not talking about how there's market volatility and how that there is really nothing guaranteed in investing. I'm talking about how these returns that you hear about are not the actual returns that you're going to get. We're going to look at the money that you'll actually make, and then we're going to talk about which asset is the best in terms of real return. Okay, so firstly, I know when I started becoming interested in investing, and I'm sure many of you can relate, I was trying to seek out the best asset that could return me the most money. Why wouldn't I want a 10% return on my money every single year instead of a 2% one? Then you see, you start getting hooked on the idea of these returns. You know that there are no promises and that the market is volatile, but you also think that on average you will get this 10% back every single year. And when you see that this isn't actually the case, you start to wonder what went wrong. The problem is that these are the average returns, not the real average returns. It's kind of like how you're told your gross salary when you get a new job, and you start getting really excited and planning what you're going to do with all this extra cash. But as soon as your first paycheck comes in, you realise that you're not actually getting this salary. The salary that you thought you were getting is the non-adjusted salary. The salary before tax and all the other things that get taken away. And it's the same picture with returns on investments. You need to instead think about the real returns. Real returns are the returns adjusted for inflation. The amount you may earn from an investment after inflation is actually taken into account. Real returns are lower than nominal returns, which don't subtract taxes nor inflation. So it's that return minus inflation and any taxes that are applicable that gives you your real take-home return. You may have heard that holding cash right now is a big mistake and that inflation will just come along and eat it all up. Well, that's because the return on cash that you hold within the bank, so the interest, is at an all-time low, currently sitting at around 1.25% here in the UK. Which is actually the highest it's been in the last 13 years, but is still nowhere near where it used to be. If you then take a look at the inflation that's happening right now, you begin to see the problem. Just recently, inflation rates in the UK have hit 9.1%. And if you take your return, your interest of 1.25%, and you minus inflation of 9.1% to get your real return, you're left with negative 7.85%. Not looking great. If you put £5,000 into a savings account that offers 1% interest rate, then over the course of a year, you'll earn £50. However, that £50 is not quite what it seems. If at the same time, the inflation rate is at 9%, which it was in June 2022, so just a month ago, the cash in your savings account is actually only losing value. After 1 year, your £5,000 pot adjusted for inflation will only be worth £4,550, which is still only £4,600 when you add the 1% interest. You can see that your purchasing power is just decreasing, and this only gets worse over a long time. Of course, having savings and access to cash is really important for many things, but we're trying to work out what the best asset is in terms of real return. And with the current economic market, it seems that cash is not in our number one spot. We've said that cash is not the best asset. So what is? Perhaps bonds? A 20-year UK government bond will return about 2.7%. But with inflation as high as it is, this again will give negative real returns. We have to remember that inflation rates will probably come down once again. And investing is something that you do over a long period of time. So just naturally, you'll have periods of higher inflation rate and periods of lower inflation rate. But it's still really interesting to think about. If the inflation rate came down to 2%, which is where the Bank of England is targeting it to be in order to keep inflation low and stable, then the real return on these bonds would actually be 0.7%. Let's now take a look at stocks as a potential asset. There's those passive stock investments like ETFs and index funds, and of course there are also individual stocks. If we take the S&P 500, which sits at about 10% return on average, when you minus inflation, this figure obviously decreases, but it doesn't go negative as it does with cash and bonds that we've just looked at, which potentially could make it a better option. But nothing in this video is meant to be taken as financial advice. You could also take a look at the QQQ, which tracks the NASDAQ 100 index, which is a basket of the 100 largest, most actively traded, valuable US companies, and it's very tech heavy. Whilst on average this does tend to return higher than the S&P 500, it is also more volatile and risky. So you need to really think about risk versus reward. Perhaps a better investment is individual stocks. Sure, you can definitely get better return on these, but it's harder to do and a lot less predictable. There is a reason that this is called active investing. You need to actively put in time and research. If you're investing into individual stocks during times of high inflation, it may be worth considering which companies are actually going to be the best options to put your money into during these times. Watch this video up here if you want to learn how to recession-proof your portfolio. Something else to think about here is how much you can protect your assets against tax. In the UK, we have something truly beautiful, and that is our Stocks and Shares ISA. It's a type of savings account which allows you to never pay tax on any income or capital gains that your investments actually make, or on any interest the cash earns. Each person can invest up to £20,000 per financial tax year, and this gets reset every single financial tax year. But you can't carry over any unused allowance. This is great. This means that once you've got your return and you've adjusted it for inflation, you don't then have to also think about the implications of tax. You can hold bonds inside of your tax-protected ISA as well. Let's move on to another asset type. Property. In the UK, we are obsessed with owning property. I guess this is because it's a tangible asset, and it's one that can rise in value over time whilst you can still make an income on it. Property is a little bit more difficult to quantify in terms of real return, and that's because there are just so many variables surrounding it. The price that you paid for it, the price that you sell it for, are you renting it out for an income? What is the real return on that? Did it need much work? How much does it cost to maintain the property? Where in the country it's actually located? And so on. For example, look at the difference here in selling prices between Durham and Reading, two places here in the UK, between 1995 and 2017. If you had bought a property in Reading in 1995 and then you went on to sell it in 2017, you would have made a really nice real return on it. But if you did the same thing in Durham, not so much. In the UK, there are also other taxes to consider. The buy-to-let tax, capital gains tax, stamp duty, and I may even be missing some here. Inflation can cause the housing market to go a little bit mad. I know right now that properties around my area are going for way more than they're actually worth. And people that are looking to purchase a house are really struggling because they're just getting outbid where the prices are going crazy. So if you were selling a house in a desired area right now, you'd have a really good asset there and you'd probably have a juicy real return. Inflation rates may remain high for a while. And of course we have taxes. So just bear in mind the importance as an investor of real returns when making your investment choices.